You can feel it, can't you? That thin, artificial calm they try to paint over the tape right after a holiday week, right after a year-end close, right after the books get dressed and the headlines get cleaned up. The screens look orderly. The percentages look polite. The talking heads call it a pause, a breather, a reset. But when I look at silver right now, I don't see a reset. I see a battlefield that's been freshly swept, with drag marks still visible in the dust. Because here's what happened in the open. Silver was trading around the low 70s, call it roughly 72.66 on a live spot, quote, after printing the day's range that should make any adult in the room sit up straight, about 71.295s on the low end and 74.575 on the high end. That's not quiet. That's not stable. That's a hollow order book getting punched in the ribs and pretending it didn't flinch. And while that range was unfolding, the so-called fear gauge was sitting low, around 1451 on the VIX, like the crowd was asleep in the stands while the fighters are still throwing elbows behind the referee's back. So let me ask you a question. If volatility is low, why is silver swinging like a door in a hurricane? Because volatility isn't just what the VIX says it is. Volatility is what happens when a leveraged paper market runs into a physical world that doesn't care about your models. And silver is where those two worlds collide the hardest. You saw it in the cross currents. The dollar index was firm, call it around 98.16 to 98.43, depending on which snapshot you caught. And the 10-year Treasury yield was hovering around 4.189% to 4.191%. Those are the weights they hang around silver's neck. A firmer dollar, higher yields, tightening financial gravity. And yet, silver still pushed up in that same window. Reuters had spot silver around $74.03, up about 0.9%, even with the dollar holding up and yields pushing. Earlier in the day, Reuters had spot silver near $71.77, while U.S. silver futures were around $74.69, up about 2.9%. Now, people who only live on charts will tell you that's just momentum, technical buying, risk on. No. Sometimes, silver rising alongside a firm dollar, silver disappears into industry. Silver turns into a supply chain problem. And supply chain problems don't respect paper prices. So the system reacts the way it always reacts. It doesn't argue with you on the fundamentals. It attacks the structure. It attacks the leverage. It attacks the liquidity. It attacks the weak points. And one of the biggest weak points sitting right in front of you, quietly like a tripwire across a dark hallway, is mechanical selling, the index machine. There's a report floating around, attributed to analysts at a major bank, suggesting that the Bloomberg Commodity Index rebalancing window, running from January 8th through January 14th, could force a meaningful amount of silver futures selling. The estimate being cited is about $3.8 billion in silver futures selling, something like 13,000 COMEX silver lots, framed as a chunk of open interest. Now, whether that estimate lands precisely on the number or not, the concept is what matters. This is not discretionary selling. This is not investors deciding silver is overvalued. This is an algorithmic schedule, a mechanical process, a spreadsheet-driven shove, and silver is the kind of market where a shove becomes a punch because it's thinner than gold, less deep, more sensitive to flows, more vulnerable to air pockets. So imagine that window. Early January, the desks are still waking up, liquidity is still patchy, the market still has that ghost week feel, like the adults haven't fully returned to the casino. And then you get a chunk of forced selling hitting a market that's already jittery. What happens? The price drops, stops trigger. Options dealers hedge, risk engines kick in, margin gets stressed. Funds that are levered get forced to sell. And suddenly, the move that started as mechanical index rebalancing turns into what it always turns into in silver, a cascade, a feedback loop, a stretched rubber band snapping and whipping across the room. This is not a normal dip. This is not a healthy correction. This is not profit-taking. This is a machine-driven flush that can rip silver out of weak hands at a discount, right when the market is thin enough for predators to control the tape. And the predators love thin windows. They love overnight sessions. They love pre-open. They love after hours. They love holiday weeks. They love Friday afternoons. They love the moments when the order book is hollow and the liquidity is ghostly. Because in a full market, an ambush leaves bruises on the attacker too. In a ghost market, the attacker walks away clean. That's why I always warn you. The most dangerous silver moves rarely happen at noon when everyone's watching. They happen in the graveyard shift. They happen at 3 a.m. market. They happen when the casino looks empty. And then the headline comes out later, dressed up like it was all perfectly rational. Now, while all that paper machinery is grinding, there's another angle most people miss because it doesn't show up in a single clean price print. The proxy vaults, the ETFs, the trusts, the paper that claims it's physical. Let's talk about SLV first, because SLV is one of the biggest bridges retail ever built into the silver market. And here's what people do with that. And you don't need a single Shanghai Premium print today to understand the structure. You just need to understand the behavior. If you're sitting in New York arguing over whether a moving average crossed a line, you're playing in a paper sandbox. If you're running a factory and you need metal, you don't care about the sandbox. You care about the bar, you care about delivery. You care about whether your supplier can actually source. That's the East-West fracture in one sentence. The West argues about price, the East pays for metal, and silver is where that fracture becomes visible first because silver isn't just money, it's material. Which brings me to PSLV. PSLV reported holdings around 210,706,999 ounces of silver. NAV around 24,999. A daily change around 0.40, about 1.61%. And the market price was around $24.23, showing a premium discount of about 3.03%. I want you to sit with that. A physical silver trust showing a discount. What does that mean? It means the paper wrapper can trade below the value of the metal it represents. It means sentiment can temporarily overpower physics. It means liquidity needs can force selling even in vehicles tied to physical. It means you can get mispricing even while the structural story remains tight. And that's exactly how the system shakes you out. They don't have to prove silver is abundant. They just have to create enough confusion that you doubt yourself. They just have to create enough volatility that you confuse structure with noise. They just have to create enough air pockets that you think the floor is falling out when it's actually the paper market dumping into thin liquidity. And the thin liquidity story matters right now more than ever because early January is still part of the ghost market hangover. People aren't fully engaged, desks are still thin, and the tape is vulnerable. That's why those live spot quotes matter. And the damage doesn't happen evenly. It hits at stress points. And the biggest stress point in any leveraged market is the rule book, margins, clearing, the kill switch. There's a clearing advisory sitting out there, late December, showing the margin framework that governs these markets. You don't need to memorize the table to understand the message. When volatility rises, the exchange can raise the cost of holding paper exposure. They can change the rules, they can demand more collateral. And when they do, it's not because the market is calm, it's because the market is dangerous. This is the part most people don't want to internalize. In silver, the fundamentals can be screaming bullish, and you can still get crushed in the short run if you are on the wrong side of leverage. Because leverage is the system's favorite weapon. They can't print a single ounce of silver, but they can print pain through margin. They can trigger forced liquidation. They can create an engineered flush. And every time that happens, the headlines will try to make you believe silver is bubbling and popping like some meme stock. That narrative is already being pushed. There are reports pointing out the weird optics. Silver EOS, price per ounce, exceeding the price of oil per barrel. Silver around the $70 handle. Oil around the high 50s. And people dragging out 1980 comparisons like a ghost story to scare you back into the house. There are also claims being circulated about how long silver has gone without a deep correction. Numbers like 833 days without a 20% drawdown, flirting with historical comparisons, framed as bubble signals. Let me be surgical here. Those kinds of narratives always show up at the same time in every cycle, when an asset is rising and the system needs you to fear it. They call it a bubble when they want you out. They call it stability when they want you in. So ask yourself, if silver is truly just a bubble, why does the system need so many levers to control it? Why do we have to talk about forced index selling windows? Why do we have to talk about margin frameworks and clearing rules? Why do we have to talk about repo facilities quietly taking tens of billions? Why do we have to talk about the dollar and yields as if they are weapons? Because this isn't just a price chart. This is a structure built on paper, promises, defended by liquidity injections, and vulnerable to physical reality. And that's why I keep bringing you back to the same core conflict, paper versus physical. On paper, silver is a number on a screen. In reality, silver is bars, inventory, supply chains, and delivery. On paper, the market can create infinite claims. In reality, there are only so many ounces that can actually move. On paper, you can settle with cash and roll and net and hedge and hide. In reality, industry needs metal. And when you look at the macro backdrop, dollar firm, yields elevated, curve dynamic shifting, you can see the system trying to keep its footing. That 10-2 spread moving to around 31.32 BPS, jumping in a way that catches your eye, is part of the bigger story. Rates are not stable. Funding is not perfectly smooth. The bond market is still a living animal, not a dead spreadsheet. And every time that animal twitches, silver reacts because silver sits downstream of rates in the paper world and upstream of industry in the physical world. It is pulled from both sides. So what do we do with this information? We connect the dots, and we stop letting the system tell us what the dots mean. Dot 1, silver is swinging wide in live trading, low 70s up to mid 70s in the same breath, while the crowd pretends volatility is low. Dot 2, the dollar is firm and yields are high enough that, historically, silver should be struggling more than it is. Dot 3, despite that, silver still pushes higher at key moments, spot printing around $74.03 while the dollar holds. Dot 4, the plumbing flashed a confession, record repo borrowing. Dot 5, the mechanical machine is lining up a potential shove. Index rebalance flows in early January. Dot 6, the proxies show the size of the battlefield, hundreds of millions of ounces in the big vehicles, while discounts and premiums remind you that even physical wrappers can get distorted. Dot 7, the narrative machine is already warming up the propaganda. Bubble, 1980, overbought, it's gone too far. Now, here's the question that matters. Is this an argument about whether silver is overvalued today? Or is this a preview of how the system behaves when silver refuses to behave? Because I'll tell you what I see. I see a system that can tolerate gold rising because gold is the establishment's metal. Central banks can hold it. Institutions can hedge with it. It fits inside their worldview. Silver doesn't fit as neatly. Silver is the metal that exposes the fragility because it's harder to fake for long. Not impossible to fake in the short run. No, they can absolutely smash it with paper. They can ambush it in thin liquidity. They can shake people out with margin and stops and narratives. But harder to fake indefinitely because the physical demand keeps pulling, because the physical market keeps tightening, because silver's role in the real economy keeps growing. So when silver acts like it did in this window, violent range, firm dollar, elevated yields, and yet it still presses, it doesn't scream bubble to me. It screams stress. Stress in positioning, stress in the paper complex, stress in the plumbing. And when stress rises, the system does not behave calmly. It behaves defensively. It behaves like a cartel under siege. It changes rules. It injects liquidity. It frames narratives. It picks attack windows. And it tries to make you feel like you're the crazy one for noticing. You're not crazy. In that downdraft, you can see the classic sequence. First, price dips into an air pocket. Liquidity thins, stops trigger. Then, options dealers hedge. Gamma dynamics turn the move into a slide. Then, margin stress hits anyone levered. Forced liquidation kicks in. Then, the narrative machine screams bubble. Headlines intensify. The weak hands panic. And while that's happening, the people who understand silver, the ones who don't talk about it like a video game, quietly accumulate, quietly move toward physical, quietly take exposure where it can't be margin called away, because that's the secret the system never wants you to learn. The paper market is designed to attack your timing. The physical market is designed to reward your conviction. Paper is where they can play games with you. Physical is where they eventually have to pay. And if you want the cleanest metaphor for it, it's this. The chart is silver ink. The real story is silver metal. And the moment the system starts injecting liquidity in record amounts, the moment it starts leaning on mechanical flows, the moment it starts whispering bubble, the moment it starts tightening the rulebook, that's not silver failing. That's the system showing you its hand. Because if everything was truly fine, they wouldn't need any of these tools. They wouldn't need thin liquidity ambush windows. They wouldn't need forced program selling. They wouldn't need a narrative campaign. They wouldn't need a central bank backstop taking tens of billions. They wouldn't need to keep the casino lights dim while they move the furniture. So here's where I land, and I want you to hear it as plainly as possible. This is not a normal market. This is not a fair market. This is not a market where the screen price is the whole truth. This is a market where paper claims and physical reality are drifting apart, and silver is the bridge that's starting to fracture under the weight. Gold will keep being the benchmark, the older brother, the institutional safe haven. But silver is the opportunity in the battlefield, because silver is where the system can't hide forever. They can play with the screen. They can bully the chart. They can manufacture fear and thin liquidity. But they cannot print a single ounce of silver. And at some point, whether it's through a funding crack, a delivery squeeze, a supply chain choke point, or a simple exhaustion of willing sellers, the price on your app will have to admit what the vaults and factories already know. They can rescue the paper. They cannot rescue the metal.